welcome to my channel. What I do in my videos is I run my discounted cash flow model. I built it in Excel myself, and I try to figure out the value of a company's stock. I also look at the company's financial ratios and compare them with its competitors. And I do this with you throughout the entire video, so it's like we're doing it together. And the company I'm looking at today is OTC Markets Group. And this was previously known as Pink Sheets. And this company provides price and liquidity information for almost 10,000 over-the-counter securities. OTC securities are securities that do not trade on major exchanges like the NASDAQ. Let's get started with the model. This company has a market cap of $349.8 million. So that's the value of the company according to the stock market. So if you take the stock price multiplied by the shares outstanding, you get the market cap. And they're trading at $30 a share, so that's one share of stock. And the way you value a company or an asset is you estimate the future free cash flows that it generates. And then you discount that number back to today's value. And that's what I'm doing in this video. Now I'm pulling the actual free cash flows, because that's a big part of calculating the future free cash flows. We also need the net income, which is the profit and loss on the income statement, but it's accounting profit and loss, so there's a lot of non-cash items on the income statement that need to get stripped out. That's why we use the free cash flows. And now I'm going to pull the revenue, which are the sales for each year. And every year the revenue goes up about $4 million, which is pretty consistent, I might say. And let's look at the numbers. I like to see free cash flow above net income, and it is every year, so that's good. They have pretty consistent numbers, so we should get a good value. Let's look at the capital structure of the company. They have no debt, that's great. Let's get their beta. The beta is how volatile the stock is relative to the market. And they have a beta of 0.54, so the stock moves about half the market, which is a good thing. You want a stock with a low beta, that means there's less risk. We also need the current assets. The current assets are used to calculate the current ratio later, and it's mainly cash, accounts receivables, and inventory. That's 35 million. We also need current liabilities to calculate the current ratio. That's debts and payables due within 12 months, that's 25 million. And the equity, which is total assets minus total liabilities, that's about 18 million. And their earnings before interest and taxes, that's on the income statement, that's 18 million. And we need all these numbers to calculate some ratios later. Let's look at the capital structure of the company. They're 100% equity, and the cost of equity is 6.5%. The way we figure that out is using a capital asset pricing model. And that's a discount rate we're going to apply to the future cash flows. So we estimated 4 years of future free cash flows, and that estimate is based off of the prior financial information. We also estimate a terminal value, that's 321 million. That's all cash flows after year 4. We discounted those numbers back to today's dollar amounts using the weighted average cost of capital. And we get a value of the company of $326 million. We divide that by 12 million shares, and we get an intrinsic stock price of $28. It's trading at $30, so it's trading at a 7% premium. So it's a sell according to the model. Let's see what Simply Wall Street values the company at. They're at $26, so they're in the same ballpark as me. Let's see where the stock has been trading. So it looks like it was trading much lower a few years ago, but it's going up little by little every year. It did drop a little at coronavirus. It's come up a bit, not too much, but it looks like it's trading around intrinsic value. Investors are not willing to pay a premium for the stock. They just see the value where it is right now at around $30. Let's look at the financial ratios of the company, see if we get more information. They have a pretty bad PE, a bad price of sales, and a bad price to book. So PE is price of stock over earnings per share, and to get earnings per share, that's net income over shares outstanding. And I like to see a PE below 15. They're at 23. Price to sales ratio is stock price over sales per share. To get sales per share, that's revenue over shares outstanding. I like to see below 2.5. They're at 6. Price to book ratio is stock price over book value per share. And to get book value per share, that's equity over shares outstanding. I like to see below 3.5. They're at 20, so they don't have a good book. They have a good current ratio and an amazing ROE. So current ratio is current assets over current liabilities, so they can cover their current liabilities, no problem. That's great. ROE is net income over equity, so they provide their equity holders an amazing return, 85%. The best way to look at ratios is to compare them to similar companies. I've done a video on ICE, Intercontinental Exchange, and they own major stock exchanges. And I'm comparing them to OTC, and OTC does have a better price to earnings and price to sales. ICE has a much better price to book ratio. They're both doing okay in current ratio, they're both above 1. ROE, OTC is just knocking it out of the park at 85%. OTC has no debt, which is great, but they're much smaller of a company. So these seem like pretty stable stocks to invest in because the stock market isn't going anywhere. Let me know what you think of the video. Thanks for watching.